In the interconnected world of global trade, currencies serve as the lifeblood of commerce, facilitating the exchange of goods and services across borders. They determine the price of goods and services exchanged between nations, impacting everything from the cost of your morning coffee to the profitability of multinational corporations. Exchange rates are a critical factor in the global economy. When exchange rates fluctuate, the ripples are felt far and wide, affecting businesses, consumers, and governments alike. Imagine a business in the United States importing raw materials from China. The cost of these materials can vary significantly based on the exchange rate. If the US dollar weakens against the Chinese yuan, those materials become more expensive, potentially squeezing profit margins and affecting the overall cost structure. On the other hand, a strong dollar makes imported goods cheaper for American consumers, but it can hurt US exporters by making their products less competitive overseas, impacting their sales and revenue. Beyond trade, exchange rates influence investment decisions, guiding where capital flows. Investors seek opportunities in countries with stable currencies and strong economic fundamentals, aiming for steady returns. Conversely, volatile currencies can deter investment, hindering economic growth and creating uncertainty in the market. Understanding currency movements is essential for navigating the complexities of the global marketplace, helping to mitigate risks and seize opportunities. The stability of the global financial system hinges on the delicate balance of exchange rates, which requires constant monitoring and adjustment. Central banks and policymakers closely monitor currency movements, intervening when necessary to prevent excessive volatility and maintain economic stability, ensuring smooth functioning of the economy. For businesses, investors, and individuals alike, staying informed about currency trends is crucial for making sound financial decisions in an increasingly interconnected world where every fluctuation can have significant consequences. The global currency market is a vast and dynamic arena, home to a diverse array of currencies, each with its own unique characteristics and influences. This market is constantly evolving, driven by economic, political, and social factors that shape the value and stability of currencies worldwide. At the forefront stand the major currencies: the US dollar, the euro, the Japanese yen, the British pound, and the Swiss franc. These currencies are the pillars of the global financial system, providing stability and liquidity. These currencies dominate international trade and finance, serving as benchmarks for global transactions and reserves. They are trusted by investors and institutions alike, ensuring smooth and efficient cross-border trade. The US dollar reigns supreme as the world's reserve currency, reflecting the size and influence of the US economy. It is the most widely held and traded currency, often seen as a safe haven in times of economic uncertainty. The euro, used by 19 European Union member states, represents a significant economic bloc. It is the second most traded currency, symbolizing the economic strength and unity of the Eurozone. The Japanese yen, known for its stability, plays a crucial role in Asian markets. It is often used as a benchmark for other Asian currencies and is a key player in the region's financial landscape. The British pound, with its long history as a global trading currency, remains influential despite Brexit. It continues to be a major currency in international finance and trade. The Swiss franc, often seen as a safe haven currency, attracts investors during times of global uncertainty. Its reputation for stability and security makes it a preferred choice during volatile periods. Beyond these established players, a new generation of emerging market currencies is gaining prominence. These currencies are becoming increasingly important as their respective economies grow and integrate into the global market. These currencies, representing rapidly developing economies, offer both opportunities and challenges for investors. They can provide high returns but also come with higher risks due to economic and political instability. The Chinese yuan, reflecting China's growing economic might, is increasingly used in international transactions. It is a key currency in Asia and is gaining acceptance worldwide. The Indian rupee, driven by India's booming technology sector, is attracting attention from global investors. Its growth is a testament to India's expanding economic influence. The Brazilian real, linked to Brazil's vast natural resources, remains sensitive to commodity price fluctuations. It is a key currency in Latin America, reflecting the region's economic potential. Understanding the dynamics of both major and emerging market currencies is essential for navigating the complexities of global finance. This knowledge helps investors make informed decisions and manage risks effectively. By closely monitoring economic indicators, geopolitical events, and central bank policies, investors can position themselves to capitalize on opportunities and mitigate risks in this ever-evolving landscape. Staying informed and adaptable is key to success in the global currency market. Predicting currency movements is no easy feat. It requires a deep understanding of various economic, political, and social factors that can influence the market. It's like trying to forecast the weather with numerous interconnected factors influencing the outcome. Just as meteorologists use data and models to predict weather patterns, economists and analysts use a range of tools to anticipate currency movements. However, by analyzing key economic indicators, geopolitical trends, and central bank policies, we can gain valuable insights into the potential direction of currency markets in 2025. These insights can help investors and policymakers make more informed decisions. Economic recovery will be a key driver. As economies rebound from the pandemic, the strength and speed of their recovery will significantly impact their currency values. Countries emerging from the shadow of the pandemic with robust growth and strong fundamentals are likely to see their currencies appreciate. This appreciation reflects investor confidence in the country's economic prospects. Conversely, nations grappling with sluggish growth or high debt levels may experience currency depreciation. This depreciation can lead to higher import costs and inflationary pressures. Central bank policies will also play a crucial role. Decisions on interest rates, quantitative easing, and other monetary policies can have immediate and long-term effects on currency values. Interest rate differentials between countries can influence capital flows, impacting exchange rates. Higher interest rates can attract foreign investment, boosting the currency. Inflation, the arch nemesis of stable currencies, will be a major concern in 2025. High inflation erodes purchasing power and can lead to currency devaluation. Countries successfully taming inflation will likely see their currency strengthen, as stable prices foster economic stability and investor confidence. While those struggling to contain rising prices may face currency weakness, persistent inflation can deter investment and reduce economic growth. Geopolitical events, often unpredictable and swift in their impact, can also roil currency markets. These events can create uncertainty and volatility, affecting investor sentiment. Trade tensions, political instability, or global conflicts can trigger volatility and uncertainty. Such events can lead to rapid shifts in currency values as markets react to new information. The energy sector, a major player in global trade, will continue to exert its influence on currencies. Fluctuations in oil prices can have significant effects on the currencies of both exporting and importing nations. Oil exporting nations may see their currencies appreciate if oil prices rise, benefiting from increased revenue and trade surpluses, while oil importing countries could face downward pressure on their currencies. Higher oil prices can increase import costs and trade deficits. Commodity prices, sensitive to global demand and supply dynamics, can also impact the currencies of commodity-dependent economies. Changes in commodity prices can affect trade balances and economic stability. Navigating the complexities of currency markets requires a keen understanding of these interconnected factors. Staying informed and adaptable is key to managing risks and seizing opportunities. By staying informed about global economic trends, central bank policies, geopolitical developments, and commodity markets, investors can make more informed decisions in this ever-changing landscape. This knowledge can provide a competitive edge in the dynamic world of currency trading.